Hi, everybody. It's Dr. Robinson. It's the October 14th, 2022 issue of Money Masters Weekly Update. My contact information there on the screen if you have any questions about anything we've talked about today or any questions about anything in general. Having said that, I'm going to try to keep this as a little bit briefer than we have been. I do have about 7 slides I want to go through, but I'm going to kind of speed it up a little bit. Got to get down to Florida, meeting with the claims adjusters on the properties and stuff. So got a long weekend ahead of me. Having said that, itinerary today, pretty simple. We're going to go through the financials, talk a little bit about market volatility. We've seen some wild swings, especially the last 2 days, but we'll talk about those in just a bit. This is the meeting where we do the quarterly. So quarterly results are in. So third quarter results actually were better than I thought they were going to be. Results came in at 552. Our trading costs were a little higher. I did have that fiasco back in, if you remember, in August, where we had some issues. So trying to fix those trades and stuff, ended up having a lot more trades than I would normally do. But our trading costs were $1.47 on a per share basis. Our expenses were also a little higher, 31 cents for accounting and some legal stuff. Taxes at 82 cents a share. So as of 9:30, our net NAV, and of course this is the net, was $20.11. I didn't do the calculation from the previous quarter, but that was about $3 greater than what we had back in the second quarter of this year. So on the weekly side, let me show you the on the weekly side. So on the weekly, I had a pretty good week this week. We did take advantage of some of that volatility. It was scary at times, I got to tell you guys. There were moments where I was a little worried, a little freaked out, tried to stay calm, but it was kind of a wild ride this week. The swings were just wild. Even once you got into a trade, it wasn't uncommon to be up 30 cents and then down 40 cents and then back up 50 cents, just all within a minute or two. So wild swings, but our starting NAV from last week, 10/7, was 20.32. Net gain for the week is $1.24. So our ending NAV this week is 21.56 or $21.56. So our gain for the week, 6%, a little over 6% for the week. Pretty good week. Pretty happy with that, especially given all the volatility and the fear that's in the market right now. As far as our other slides that we look at, the treasuries or interest rates are continuing to climb. That's part of where this volatility is coming from. It's not the only thing. England is giving a good bit of volatility to the markets. The British gilt, which is what we would call treasuries, they call gilts. So their gilts are kind of upended. They fired their director, or their what we would think of as like the Treasury Secretary. So their director of the Exchequer was fired. So I'm not sure where England's going to go. England's a mess right now, guys. I don't think it has a lot to do with our markets. I don't think there's any contagion to the U.S. markets from what's going on in England. They've just got to suffer through some of the stuff that they've got to get through. So at the end of the day, we are starting to see, or continuing to see, interest rates increasing again in the United States. So a week ago, you can see that the one-year Treasury is up 30.5 basis points or bips. The two-year Treasury is up 19.7 bips. The three-year 25.7. So again, you see these big rises on the short end of the range on these bonds. The 5-year bond up 13.1 bips, and then of course the 7 at 13.6, 12.3 on the treasury, on the 10-year Treasury. But notice that yield, by the way, guys. We've kind of played around 4 for a bit, and then we did spike back when the hurricane was going on, and I couldn't pay a lot of attention to the market. But all of that volatility has kind of gone away. But here we are back to 4% on the 10-year bond. So 4% on the 10-year bond does not bode well. I think that implies if you follow the Fed's numbers, their dot plot. We talked about their dot plot a few weeks ago. But if you follow their dot plot, the ending Fed, they call it the terminal Fed, might be closer to 5, maybe even over 5% in a year from now or 6 months from now. So we had been thinking that the Fed was going to probably take interest rates up to maybe 4.25. Some people believe 4.5. And then it started rising a little bit. They got to 4.6, and now we're starting to think that it might be over 5. Now, I don't care about that stuff. I don't follow those dot plots in terms of what people speculate because there's just no telling what can happen between now and then. So we could see interest rates go back down. We could see them continue higher. At the end of the day, we don't really know. If you go back a couple of weeks, by the way, when the hurricane was going on, and again, I wasn't paying a lot of attention to the market. I was keeping track of bond movements, though, because I usually do. The 10-year had gotten up to well over 4, and then dropped all the way back down to 3 point. I think the low I remember is 3.4, 3.46 or 5 or something. So this thing can be volatile at times, and it has been. But a little bit of that volatility is kind of coming back here, but it's in a more steady. It's not those wild swings like we're seeing in the stock market. It's more a steady increase in volatility. So it is over 4. That's not generally good news for the economy. That makes borrowing for everything a lot more expensive. Of course, the 10-year or the 30-year rather, you'll notice that one's up also 13.7 bips. And the 10-year is now inverted over the 30. And again, that's not something we normally see. So again, if you ask a question to a bond investor, why would you buy a 30-year bond instead of a 10-year bond? You'll get more money on the 10-year bond, and you have a lot less duration risk where, you lock your money up for 30 years on a 30-year bond versus a 10-year bond at just 10 years, of course. But if you go any further, I mean, you could take this to the extreme and say, well, why would you even buy a 10-year bond? Because you're going to get more money on a 1-year bond and only have 1 year of duration. So at the end of the day, a lot less risk on that short end versus the long end of the treasuries. As this continues to go like this, there's more and more likelihood, and I've been telling you guys over the last few weeks, the likelihood of a deeper recession is starting to become more obvious, I want to use, or the word I want to use is obvious. So I had been originally telling you that I thought we were going to have a little bit longer recession than normal, but it wasn't going to be that deep. If this kind of stuff continues, we might see a much deeper recession. I don't think it's going to last that long, by the way. I do think that the Fed is at some point going to have to realize that if these rates continue to go too high, if we start facing a Fed funds rate at 5, 5.5, or even, God forbid, 6, that they're going to have to stop raising rates at some point. There is no indication that's at this point, by the way, that they have any intention of slowing down their increases. They were very clear this week. We heard 6 or 7 people this week talking about rates out of the 12 members who vote for increases in interest rates. Out of the 12, 6 of them came out and said there's nothing on the table right now about slowing this down. So that may be true for now, but again, what's going to happen as we get into later in the year or at the end of the year or even early next year, not entirely sure because I don't have a crystal ball. Nobody does. But I can't imagine they're going to keep doing 75 basis points from here on. I do think that there's a really high likelihood that we're going to see another 75 basis points in November. I told you guys originally a couple of weeks ago that I thought that maybe in November we might see 50 basis points increase instead of the 75. But that was based on the idea that, the core inflation, the CPI, core and non-core numbers, and the PPI along with it, personal consumption expenditures, that's called a PCE, kind of assuming that those were going to come down a little bit. And turns out they're not. In fact, we got some information yesterday on the CPI. The core CPI was actually higher than what we thought. So the inflation rate's kind of gone back up to an 8.5% on an annualized basis, which again kind of implies, and if you think about it, the Fed has been raising interest rates since February of this year in the hopes of bringing down inflation. Now, they have brought down some on the producer side. If you remember, the highest we had on the producer inflation was 11.3, I think it was. That has come down, but it's only come down into the 9s. It's got a 9 handle on it now. So that one's coming down, but the core CPI, that's the one that you and I pay. That's for the consumers. Our inflation rates are not coming down. Now, we did see some decreases over the summer a little bit, but it turns out it looks like most of those decreases were just from the gas prices. So gas prices are coming down, and that made everybody believe that maybe CPI was coming down. So therein lies that hope that if gas prices are coming down, CPI is coming down, therefore the Fed can reduce the rate at which they raise rates. But it turns out that those gas prices coming down was artificial. A lot of it was from Joe Biden taking money, or taking oil rather, out of the strategic petroleum reserves in Oklahoma. But that oil's got to be replaced. That's oil that was supposed to be used, or is supposed to be only be used in an emergency when we effectively go to war. In a war, you got to make sure that you have ships and airplanes and stuff that have adequate access to oil and fuel and gas and stuff, and that's what that gas is for. But he opened the reserve up to try to lower prices before the election. He's got to replace that because he's taken out millions of barrels of oil out of that reserve. So that oil has got to be replaced at some point. So it turns out that these decreases in oil prices have been a little bit on the kind of phony side, if you will. It's artificial. There are some decreases in usage, by the way, so it's not all Joe Biden. I don't want to blame him. I blame him for a lot of things, but I'm not going to blame him for all of the what's going on in the oil. There is some issues with oil supply versus demand in oil. That's why OPEC this week raised or actually lowered their output on oil. I think you guys probably read about that. So they have reduced that. They're trying to prop up prices a little bit. I understand why they're doing it. I think it's wrong for them to do it because it is something that could potentially throw the kind of the global economy into a recession. But at the end of the day, everybody's out for themselves, and we all know that. But we are starting to see indications that the recession might be a little bit deeper than we thought. Again, we'll know over in time, but I do think that in November, when they have their next meeting, we are likely to see 75 basis points again, just simply from that CPI number we got this week. I'm not sure about late December. We'll have another meeting in late December. I don't know what December is going to be. We have to wait for CPI numbers coming up later in November. My guess right now, and the likelihood to me, is it will probably see 50 basis points in December, but I'll have a better idea as we go forward, or as we get closer to that actual meeting in December. But for the moment, interest rates don't show any signs of abating at this point at all. 6 month, we've been kind of following the 6 month bill, 4.314% on a 6 month bill. So, you talk about almost, very, very little duration risk on a bond where you actually put your money aside for 6 months, but 6 months later you get your money back and you're still making a pretty good return. So overall, interest rates are very attractive right now to older people who are looking for interest income. That's usually people in their 60s, late 60s, early 70s and 80s and stuff. They love these bonds, so they're doing well, even though bond market is not doing well overall. Remember, bond prices are inverse to interest rates. So as interest rates go up, bond prices go down. But if you're willing to hold the bond for the full duration, for example, if you buy a 2-year bond, as long as you hold it for 2 years, you don't have any price decreases. So you'll still get your, remember, whenever you buy a bond, you pay $1,000 for it. So once that bond matures in 2 years, you get your $1,000 back. Plus, you've made in this case, about $45 a year in interest. So over 2 years, $90 in interest, plus you get your $1,000 back. It's nothing to write home about, especially when inflation is still with it, 8% or something. But for people who are on fixed incomes and they need income, they need additional income to cover, or supplement Social Security stuff, it's not a bad way to go. Mortgage numbers up there on the left, top left, over 7% on mortgages again. And this is a national average. It might be a little higher, it might be a little lower in your area, but 7.07% on a 30-year, 6.28 on the 15-year fixed. So again, those numbers are continuing to creep up. That's going to force fewer and fewer people, or allow fewer and fewer people to get mortgages that they can afford. Or if they do have to get a mortgage, they're going to have to buy a smaller house that has a lower price, all that sort of thing. So real estate prices will continue to abate here a little bit as we watch these interest rates continue to go up. This is the CPI I was going to tell you about. Now, I put a lot of things on this chart, and it's hard to follow it on a small little screen. But our CPI, 8.2%. That was the core number. Non-core a little higher, but we'll talk about that in just a bit. Rent of primary residence represented about 7.2% of inflation. Food and energy, 6.6. So again, food and energy have come down just a tad. Not so much food, by the way. That 6.6 decrease, or that 6.6% number, is actually a decrease from the previous month, but that was all in fuel. So it was all the gas prices coming down. But those have kind of reversed, although today was kind of a bad day for the oil if you're an oil trader. But almost all of the decreases month over month in food and energy was all in energy. Food prices are actually up this month over last month. So even though it says less food and energy was down a little bit from the previous month, it was all in the energy. It was all in gas and oil. Owner's equivalent rent, that's the OER, up 6.7%. So again, rents are not coming down. Shelter, medical care services, so Medicare or medical services and stuff, 6.5%. So we're starting to see a lot of inflation on the services. By the way, in the previous months, if you go back to March, April, May, where we had really big numbers, those big numbers were represented manufacturing costs. It was also food and energy, but it was mostly manufacturing. So it was people or companies that built stuff and they sold it to it. So it could be cars and it could be equipment that we buy, whether it's a refrigerator or a computer and stuff. So we started seeing prices rise for those. Those things have actually abated a little bit. So they're starting to level out, which is good news. Where we're not seeing any leveling is in the service side. Now, if you remember from COVID, when everybody kind of went home and didn't go anywhere, we didn't provide any services. People weren't going to the doctor as much. They weren't going to the dentist. So we started seeing reductions in values, or a lot of, think of it as deflation in those industries. Well, that seems to be over. And what has happened is, because so many dentists and doctors and accountants and all the people who provide services, and probably including insurance agents, because so many people weren't meeting with people, they're looking to replace some of that lost income, especially if you're a dentist or a doctor and you were making $200,000 a year as a dentist or a doctor, and through COVID you were only making maybe half of that because you weren't seeing that many patients because COVID was locked down. And I mean, if you're in a hospital and stuff, you're still seeing a lot of patients, but if you're a dermatologist, you probably lost a little bit of income during COVID. Well, that has reversed, and those incomes are coming up, and a lot of those doctors are starting to charge more. I don't know if it's to offset the losses, but it could also be because their expenses are going higher as well. So we are starting to see some inflation on the services side of the economy, as opposed to the product side or the manufacturing side of the economy. It's kind of been an interesting thing. We've kind of been expecting it. We actually thought it was going to happen a couple of months ago, but it is starting to come to the fore now. That's probably got a lot farther to go, by the way. Medical care, we're going to start seeing medical, insurance costs and stuff starting going up from here, probably at a faster clip than what we've seen previously. But that's the CPI number. Now, this number came out, and the interesting thing to me is this number came out on Thursday. And this was a bad number. And if you saw the futures on Thursday, the futures were up for a little bit. And then when this number came out, because it was a little bit higher than everybody thought, again, people had been expecting inflation to be kind of coming down, and it jumps up. So when this hit, the market tanked. But the interesting thing is, and that was the pre-market, by the way, we call that the futures. So the futures tanked, and I have a siren in the background. I can't control that, guys. It's just a fire truck. I'm going to let him go by a little bit. But anyway, the futures kind of tanked on that news, but the market, once the market opened at 9:30, shot right up. Now, it caught me a little off guard. I kind of expected the market to sell off that day because the news was really bad. Again, keep in mind, a lot of investors out there, especially the institutionals, they're looking for a way to get back in the market because stocks are at a discount right now. And they're just not convinced that the market's going to go down too much further. There's some people who still believe, and I'm kind of one of them, that we're probably going to see on the S&P go down to 3,300. That comes up to about 330 on the spider. So we're right now at about 360, 350. Well, actually, I think we closed today at the 350 range, or right around 360. So we're at the 360 range. So it's probably another 3,000 basis points for us to go down before we hit really what I think might be the bottom. Again, speculation, don't really know. Not in the prognostication system. We trade based on what the market's doing at any particular time, not about what we think it's going to do. But yesterday was kind of an interesting day because I thought the market was going to go down. I thought it was going to, maybe toy with that 330 range or 335 range, and it didn't. In fact, it went up. It went up to 370. So the market had a huge day yesterday despite these numbers. That's the volatility I'm kind of implying. And this is the screen I want to show you that kind of illustrates this. Now, this is a screen, this is just a quick screen print of my computer or my screen. I don't have all the details in it, but I have basically, this is a 20-minute chart, I believe. No, yeah, it's a 20-minute chart on the left. On the right happens to be a 30-minute chart. No, I'm sorry, they're both 20-minute charts. Sorry about that. But this is a chart of the last 2 days. This is a Thursday on the left and Friday on the right. Now, it doesn't look like that green line was going up that much, but notice where it kind of started. It started in that range right around 350. It was actually a little lower than that. I think the low, you can see a little bar there. It says low 348.11. So the market started out or hit a low yesterday at 348.11, but look where it ended up. It ended up at 376. Or 371 rather, I'm sorry. So from 348.11 up to 371, that was a huge day. And it was a monstrous day. And that's where a lot of that, I'm telling you, that volatility comes in. This is the scary days where you can't see it on this chart because this is a chart that smooths out a lot of the activity because of the way I tried to illustrate it for you. But if you look at let's say a 10-minute chart or a 5-minute chart, lots of ups, we call them wicks. There's lots of candle wicks, and those candle wicks are big. And again, you might be in a trade where you're up 30 cents for a moment, a 2 or 3 seconds later, and then 4 seconds after that, you're down 50 cents, and then you're back up, and then you're down, and frankly, it's a little bit, it's kind of like being on a roller coaster, literally too, by the way, because your heart just races because 1 minute, and I'll be honest with you, on Thursday, I was in a trade where I bought some calls, and the market was clearly calls, but I was in the trade for about 2 seconds, and I was already down $1. Now, I normally cut my losses when I get that big. Those are wild swings. $1 is a huge loss to us. And I'm kind of worried, and I'm trying to figure out what happened. I've actually thought for a moment that I made a mistake in my trade. I thought maybe I accidentally bought puts instead of calls, and it wasn't. I bought calls, and everything was right. But all of a sudden, I'm down $1 on the trade. And by the time, so as I'm realizing this, and as I'm trying to kind of calculate what I'm going to do here, do I take the loss? Do I wait for it to come back? Is the loss going to go from $1 down to $2? What's going on? And within 2 seconds, I'm now up 70 cents. So I went from being down $1 to being up 70 cents. And the market did continue going up from there, but that's such a wild ride. When you're down a dollar on a trade, and by the way, I don't mean a dollar, I mean $1 on a per share basis. When you're down $1, that could be upwards of $100,000. It could be, depending on how many contracts I do, it could be $500,000. And then I'm up 70 cents, and it's just one of those things that's just really bizarre. So what I ended up doing, there's a button we have on our systems called flatten, and when I was up 70 cents, I just hit that. I was like, that's just too, I like volatility. You guys know that. I talk about volatility a lot. I love volatility because that's what options traders live on. But sometimes you can get too much volatility, and that's what that was. When you're down $1 and then 2 seconds later you're up 70 cents, that's such a wild ride. You don't want on that ride. My wife used to call wild rides like that the Mr. Toad's wild ride type thing. I don't want to be on that. So we ended up taking our gains at that point. There were some other people on the call that were with me and trading, and they experienced it as well. So those are the kinds of days where even though the market looks like it was a steady up, it was anything but a steady up. It was just a wild ride. But if you held on, you made a lot of money. But you may have had a heart attack, but you would have made a lot of money. We had a pretty good day yesterday, and that's reflected in that 6% gain for the week too. We didn't make it all yesterday, by the way. But having said that, the stuff on the left, look at the page on the right. That's today. So yesterday we had this, and I think the market was up 3.6% yesterday, by the way, or I'm sorry, 2.6%. So the market is up 2.6%. That's the fifth largest in history, by the way. Markets don't move 3% a year or 3% in a day type of thing, not normally. So the market is up 2.6% yesterday, and then today the market is down 2.3%. So overall, over the last 2 days, they had a slight gain, but what came up or what went up yesterday came down like a rock today. And again, the ride, even though I smoothed it out with this longer chart and you can't see the actual candles, these candles were wild. There were again at times where you get into a trade and you're immediately down 15, 20, 30 cents. And then the market kind of comes back. And as long as you follow the trend, you're okay. Now, there wasn't as much volatility today as there was yesterday, but the volatility has increased exponentially here lately. Again, we like volatility, but there's a limit to how much we like. The idea of getting into a trade where you're all of a sudden down down $1, or on 1,000 contracts, that's $100,000 loss. So when you're down $100,000 and you're kind of wondering, is it going to go down further from here, or do I take the loss, or do I wait because a minute later it could be higher? That's a little bit too much. That does mean, by the way, whenever we see that kind of volatility, I don't trade as many contracts. So there have been a couple of times over the last week or so, because of the volatility, I've only traded 100 contracts at a time instead of my normal 1,000. Right now, there's just no way with this kind of volatility that I could trade 5,000. So, but that's okay if you think about it. If I'm trading 1,000 contracts, I usually hold on for 25 or 30 cents if I can get it, which is about $30,000 a trade. If I go into 100 contracts or 500 contracts rather, and I can get 70 cents or 80 cents or something like that on these wild swings, I can make as much on that as I did on the bigger contract, even though because I don't hold those longer or as long, simply because the volatility scares you out. So all in all, we had a good week. It's been a little bit of a terrifying week, but all in all, we had a pretty good week. I'm pretty happy with it, but we are starting to see some volatility increasing. I do think we are getting closer to a bottom. I'm not saying we're there yet. I do think we've got some more downside to go, but eventually this is going to work out and we're going to start making our way back into the stock market, but that time is not yet. Having said that, guys, I'm going to get on the road and get back down to Florida so I can talk to some insurance adjusters and see if they want to pay me for the damages we've had. So having said that, if you have any questions about anything we've done this week or this meeting, just drop me a line, let me know. Otherwise, guys, we'll see you next week.